Business owners, here's a tax break you want to include in your tax planning. Bonus depreciation. Thanks to a 2025 law, you can now write off 100% of your qualifying asset purchases immediately. In this video, I'm not giving you tax or legal advice. I'm just sharing information about the new change and how it works. Please consult your own tax or financial advisor for help with your specific situation. Normally, unless you use an accelerated depreciation method when you buy new equipment or assets, you have to spread out the depreciation over several years. But bonus depreciation lets you write off a big chunk right away in the very first year. That means if you buy qualifying assets or even certain fruit or nut plants after January 19th, 2025, you don't have to wait years to recover your cost. And the best part, the old phase down schedule is gone. Bonus depreciation will remain at 100% going forward. Automobiles are a bit different, but I will talk more about that a little later. Let's look at a quick example. You own a graphic design firm. On January 15th, 2025, you buy $10,000 worth of office furniture. Since you bought it before January 20th, you would only get 40% bonus depreciation. But if you had waited just a few days until January 20th, you could have written off the entire $10,000 in one shot using bonus depreciation. With the big shift in bonus depreciation, qualified assets acquired after January 19th, 2025 get the full 100% write-off. But timing matters. If you bought something before January 20th, 2025 and put it in service later, the rate drops. For example, if you place it in service in 2026, you only get a 20% bonus rate. And there's another wrinkle, contracts. If you signed a binding purchase agreement before January 20th, 2025, the IRS treats that asset as acquired on the contract date, not the service date. Assets under those contracts won't qualify for the 100% rate. Instead, you're stuck with the lower phase down rates. 40% if placed in service in 2025, 20% in 2026, and nothing at all in 2027. So what counts as a qualified asset? In general, it's assets that are depreciated under maker's regular depreciation with a recovery period of 20 years or less. For example, if you run a small video production company and you buy new cameras and editing software, this will count as qualified assets. And starting after July 4th, 2025, even sound recordings qualify. Another good thing is used assets might qualify too, as long as it's new to your business and you haven't used the asset before for personal use. And for those of you in specialized industries, even longer production period assets and non-commercial aircraft acquired after January 19th, 2025 qualify for the full 100% bonus. I won't get into all the details about the specialized assets here, but just know they're included. There's also something new and temporary, qualified production assets. This is non-residential real estate that's used as a vital part of manufacturing, production, or refining. If you build this kind of asset after January 19th, 2025 and place it in service before 2031, you might be able to claim 100% bonus depreciation. The catch? It has to be located in the United States or its territories. The original use has to start with you. And of course, it has to meet the IRS's definition of a qualified production activity. Please take a look at your screen for what qualifies and the key requirements. So how do you figure out how much bonus depreciation you can actually claim? Here's the basic formula. Take the cost of the asset, multiply it by the bonus depreciation rate, and then subtract any Section 179 deduction or certain tax credits you've already taken. That gives you your bonus depreciation amount. But things get a little trickier with like-kind exchanges and involuntary conversion. If you trade in assets through a like-kind exchange or replace assets after an involuntary conversion, part of that transaction may still qualify for bonus depreciation. Here's how. If the asset you receive is new, its adjusted basis may qualify. But if it's a used asset with a carryover basis, the carryover basis does not qualify for bonus depreciation. But any extra money you paid on top, what the IRS calls excess basis, may qualify for expensing. Just so you know, like-kind exchanges are now limited to real estate, while involuntary conversions still apply both to real estate and personal assets. So, new assets or extra cash paid in these transactions might get bonus depreciation, but the carryover basis of used assets does not. You do have to be careful when it comes to automobiles and bonus depreciation because the rules depend on the size and use of your car or truck. First, the basics. Your automobile can be new or used, but you have to use it for business more than 50% of the time during the year for it to qualify, and the automobile has to be new to you. You can't sell or transfer a car you already own to your business and take bonus depreciation. Also, you have to prorate your depreciation based on business use versus personal use. And one more thing, Automobiles bought with floor financing, like the way dealerships finance their inventory, don't qualify for bonus depreciation. Here's how the limits for automobiles break down. Cars under 6,000 pounds, you can claim up to $8,000 in bonus depreciation in addition to the Section 179 depreciation that you can take. There's an overall limit, though, on how much you can take each year for cars in this weight class. Vehicles between 6,000 and 14,000 pounds, you can write off up to 100% of the cost with bonus depreciation, or you can use both bonus depreciation and Section 179 depreciation. Over 14,000 pounds or special use vehicles, you can deduct 100% of the cost under Section 179 or bonus depreciation. For example, imagine you're a small business owner and you pick up a brand new SUV that weighs about 7,000 pounds and costs $60,000. As long as you're using it 100% for business, say driving to client meetings or hauling equipment, you can write off the entire $60,000 in year one. If you only use it for business part of the time, like 70%, then you'd still get a huge deduction, about $42,000 right up front. But if you also buy a small sedan to meet clients, you only get an $8,000 bonus depreciation cap on that car. And remember, if there's any leftover cost after Section 179 and bonus depreciation, you can still spread that out over time with regular depreciation. You may already know about using an accelerated Section 179 deduction to write off assets in the first year. And sometimes you can use both Section 179 and bonus depreciation at the same time. But bonus depreciation shines because, unlike a Section 179 deduction, there's no dollar limit, it's not limited to business income, and there's no phase out. Unfortunately, the upfront deduction tax break might come at a cost, because what the IRS gives up front, it often wants back later. When you use bonus depreciation, Section 1245 and Section 1250 regulations kick in if you later sell the asset at a gain. Think of it like this. The IRS let you write off a big chunk right away, but if you sell the asset for more than its reduced tax basis, part of that earlier reduction gets recaptured and taxed as ordinary income. And ordinary income is taxed at a higher rate than capital gain income. Here's an example. Imagine you own a landscaping company and buy a piece of equipment for $60,000 and you take 100% bonus depreciation. 3 years later, you sell it for $40,000. Normally, you'd think the gain is just capital gain, but because you already wrote off the full $60,000, the $40,000 is treated as ordinary income recapture, not a capital gain. That's Section 1245 in action. Now, Section 1250 is a little different, and it applies mostly to real estate. Let's say you are a small hotel owner and claim bonus depreciation on qualified improvement assets, like upgrading your lobby. When you sell the hotel, you have to compare the depreciation you claimed, including bonus, with what you could have claimed using straight line depreciation. The extra accelerated portion gets pulled back as ordinary income. So here's a practical tip. If you can use Section 179 on your real estate that qualifies for bonus depreciation, it's usually better to take bonus depreciation instead. Why? Because Section 179 gets hit with full Section 1245 recapture if you sell, and that can sting a lot harder than partial recapture under Section 1250. With all of this being said, there is an option a lot of taxpayers don't realize they have. You can actually elect out of bonus depreciation. Here's how it works. By default, you're required to claim bonus depreciation if your asset qualifies. But if you don't want to take bonus depreciation, you can opt out by attaching a statement to your tax return. The election to opt out of bonus depreciation isn't all or nothing. You make it separately for each class of asset. That means you could elect out for your 5-year assets, but still take bonus depreciation on your 7-year assets, and so on. Qualified improvement property is its own separate class. And here's an important detail. Your election has to be specific. A vague statement like taxpayer elects out of bonus depreciation for 2025 won't cut it. A proper election would say something like, taxpayer elects out of bonus depreciation for tax year 2025 for its 5-year and 7-year asset classes. Why might you elect out of bonus depreciation? Well, one reason you might do so is because you might not need the deduction if your taxable income is already low. For instance, your construction company has a slow year in 2025. You buy a $100,000 bulldozer, but your income isn't high enough to need a giant deduction now. So you elect out of bonus depreciation for your 5-year assets, spreading the write-off over 5 years instead, when your income and your taxes might be higher. Okay, back to electing out. If you filed your return without electing out, you still have one more shot. You can file an amended return within 6 months of the original due date, not including extensions. But if you miss that window and just fail to claim bonus depreciation without making an election, the IRS considers that an improper accounting method. Fixing it requires filing Form 3115 to change your accounting method. Also, There is another election option you can make. If your first tax year ends after January 19th, 2025, you can elect to stick with the old January 19th rates. That means you could claim a 40% rate for your regular qualified assets or a 60% rate for longer production assets. All right, so here's the bottom line. Depreciation is one of the most powerful tax tools you have. Section 179, bonus depreciation, and maker's regular depreciation, they're all different ways of shaping your cash flow and your tax bill. The trick is knowing which one fits your business best, not just for this year, but for the next 5 or 10. So before you jump at the biggest deduction you can grab, step back and ask, how will this play out over the next few years? Am I leaving myself with a big tax bill down the road? And how does this fit into the bigger picture of my business growth? If you use these tools wisely, depreciation isn't just a tax break, it's a tax strategy. Just don't go it alone. Talk to a CPA who knows your industry and your goals. The right advice can save you thousands. In the meantime, if you have a question, please drop it in the comments below. See you next time.